Hello all, welcome to this course on time series modeling and forecasting using R. Alright. Now we have entered into a new week and then there will be some very exciting and very interesting topics to follow. Right. Now the whole idea that we will discuss in this week or the focus of this week would be another sort of a model. So we are kind of transitioning from, let's say, simple ARMA models or ARIMA models or SARIMA models, and then we are trying to capture some aspect of a time series called as persistence. So persistence or long memory. So as you see very rightly in front of you, the title of today's lecture, especially for the first half of this week, would be persistent and long memory processes. Right? And then in short we'll discuss one particular kind of a model called as ARFIMA process. Right? So ARFIMA. Right? So again, right at the start, I'll tell you the full form of this. I mean, of course, we'll discuss lot of details about the ARFIMA process and then the, let's say, functionalities of this ARFIMA process, use cases of ARFIMA, let's say, in the subsequent lectures. Right? Now, ARFIMA, the full form is autoregressive fractionally integrated moving average. Right? So far, if you remember, we've come from discussing, let's say, ARIMA model, or for that matter, let's say, SARIMA, etc. Right? So what was ARIMA model? So ARIMA model was autoregressive integrated moving average. So if you have a trend aspect in the data set or if you have a trend aspect in the underlying process, then one can actually go with an ARIMA model. Or on top of that, if you have both trend as well as seasonality, then obviously ARIMA model won't do the job, then you have to actually shift to a SARIMA model. So SARIMA is seasonal ARIMA, right? So seasonal autoregressive integrated moving average, right? What would happen if you want to sort of perceive some persistence in the underlying time series process, or which you also call as long memory. Now again, one small point to note here is that both ARIMA and SARIMA don't sort of preserve the long memory process or the long memory nature of the underlying process. Right? So firstly, you can understand that what do you mean by persistence, what do you mean by long memory, and then eventually probably in the subsequent sessions in this week, we'll talk more deeply into what exactly is the ARFIMA process and then properties of the ARFIMA process. Right? Now the first session in this week that we are starting today, would be more of a theoretical kind of a session. So by theoretical I mean that there will be a lot of definitions, some use cases, some examples, right. So we'll try to discuss or try to find out exactly where can you actually sort of use this ARFIMA process, and then what exactly are the advantages of applying the ARFIMA process as compared to, let's say, either ARIMA or SARIMA, etc. Okay. Alright, so what exactly is the motivation? So the first motivation is what do you mean by persistence in time series? So this term persistence is kind of important and which sort of come across disciplines. So let's say finance or ecology or psychology, etc. Right? So persistence in time series refers to the tendency of the past values to have a long lasting influence on the future values. Alright. Now again, if you want, you can pause the video and then reread this definition number of times as to what exactly persistence stands for. So persistence in time series refers to the tendency of the past values to have a long lasting influence on the future values. Okay. Or in other words, it reflects the degree of memory a time series has, right? It reflects the degree of memory a time series has, that is, how long shocks or disturbances to the system affect the future observations, right. Now, a couple of things, so probably I'll explain this in a bit more detail. So firstly, persistence is what? So persistence is nothing but the tendency of the past values to have some effect or some long lasting influence on the future values. So in a way, you're saying that the future values are sort of dependent on the past values very significantly also, right. And the other term we are coining here is the degree of memory. So it reflects the degree of memory imposed on the time series, which also stands for that how long a particular shock or a particular disturbance to the system would affect the future observations, right. So a small example in this regard is that you have a stock price data over several days. So let's say you have a daily stock price data, and suddenly in between, due to some black swan events, there might be some really high jumps, right, really sharp moves, so which are also called as shocks. So what are shocks? So shocks are nothing but some external factors which are sort of driving the stock price to move very erratically. So let's say you have a lot of jump suddenly and so on, right. So once you get past of that shock, so if the influence of that shock is sort of persistent, right, again, if you go by the English definition, persistent means something which stays for some time or quite long, right. So, if the influence of that particular sharp behavior in the stock price or the shock in other terms is sort of seen in the future also, then such tendencies are called as persistence time series, right, or this tendency is called as persistence in the underlying time series. So, this whole idea about why we want a different sort of a model called as ARFEMA is to sort of preserve this persistence in the time series. Okay. Alright, now we actually have several characteristics of persistence. So, what we mean by that? So, the first one is long term impact, right. So, if a time series exhibits persistence, any shock or a shock to the system will have an influence which decays slowly over time rather than suddenly disappearing. Okay. So, probably this would be better explained through a kind of a graph. So, let us say you have the stock price behavior like this, and then suddenly you see a shock. So, you have a very sharp behavior, right. And once the shock happens, then can you see that the effect of the shock is not gone suddenly. You have a persistence kind of a thing. So, this is exactly where the shock happened, and then the effect of the shock is such that even after the shock has happened, you can see some fluctuation still. Alright. So, this is what is the long term impact. So, rather than dying the effect of the shock suddenly, it takes a while to sort of decay the influence of the shock. Alright. Now, the second characteristic is autocorrelation decay. So, if you draw the simple ACF plot in such a situation, then how would the ACF sort of behave, right. So, here if there is persistence in the time series, the autocorrelations decay slowly as the lag increases, alright. So, the ACF values or the underlying correlations so sort of decay slowly as opposed to suddenly or fast, okay. As opposed to let us say some other model called as ARMA model or ARIMA model. So, this contrasts with some of the short memory processes. So, by the way, ARMA or ARIMA or SARIMA, so all these are short memory processes. So, these models are not capable of kind of preserving the long term impacts or preserving the persistence in the time series. Okay. So, if you have ACF plots of such models ARMA or ARIMA etc., there the autocorrelations drop off more rapidly, alright. But if you are creating the ACF of let us say an ARFEMA model, then there will be some slow decay in the autocorrelations. And lastly, long versus short memory. So, what exactly you mean by that? So, you have a thing called as long memory, which is also called as persistent processes, right, such as those modeled by ARFEMA, which exhibit a slow hyperbolic decay in the ACF or the autocorrelation function, and exactly opposite to that, as we discussed a short while back also. So, you have some processes which are short memory processes like ARMA, ARIMA etc., which typically have autocorrelations that decay exponentially and quickly approach 0. Okay. So, again probably this might be explained better by some plots. So, let us say I will draw 2 plots and then both these would be ACF plots, right. So, let us say initially and then these would be the hypothetical bands, let us say, right, or the confidence bands. So, let us say if you are modeling in the ARMA process and then this is the ACF for the ARMA process, then here one can actually see that the autocorrelations are decaying sort of exponentially. So, after a while or after a very short while, you can see that all the correlations are sort of not significant anymore and they are sort of approaching 0. But as opposed to that, if you have an ARFEMA ACF, then ARFEMA ACF takes time to decay. So, you have very slow decay here, alright. So, the autocorrelations would decay, but then since you have a persistence nature in the time series, then it will take a while for the autocorrelations or the ACFs to sort of decay, alright. So, the top ACF plot is let us say for a ARMA, and then the bottom one could be for a particular ARFEMA, alright. So, this is the difference between why should you move from let us say something like ARMA or ARIMA to another model which is ARFEMA. Alright, now a few examples of persistence. So, can you give some practical use cases where persistence is important? Of course. For example, the first one is financial markets. So, let us say in finance, persistence is observed in volatility or returns, right. So, if you talk about let us say returns of a stock or returns of any asset for that matter. So, how volatile are the returns? So, volatility means nothing but how fluctuating are the returns, right. So, if the returns are sort of fluctuating very highly, then we will call that the series is highly volatile, right. So, volatility is sort of measure of how fluctuating the underlying asset price or the underlying asset return is. Okay. So, if a stock price rises sharply, let us say, persistent trends might suggest that the price will continue to be influenced by the rise for a very long time, as opposed to reverting to a previous level quickly. And I think this is exactly what we talked about a while back, where we drew the last graph also, right. So, again if you go back a slide, then this is exactly the example that we are talking about in the first situation, right. So, let us say if the price suddenly jumps and then you have a shock here, then it will take a while to sort of subside the effect of the shock, rather than again quickly coming back to the actual levels. Okay. So, this is the nature of persistence in the underlying time series, alright. Or second example could be environmental data. So, let us say climate data like temperature and rainfall often exhibit persistence, and why? So, we will take up an example. So, let us say a period of above average rainfall might be followed by more frequent such periods or more frequent rains for a prolonged period, isn't it? So, and then this we actually observe on a day to day basis also. So, especially in the monsoon season in Mumbai, if you have a day where you see really high rainfall, then probably the very next day you will again see kind of a similar kind of a rainfall. So, it will not happen that one day you will see really high rainfall and then the other day you do not see any rainfall, right. So, this is not what we call as persistence. So, persistence means that if you have periods where you have some above average rainfall activity, then such activity would take some time to sort of subside down. Okay. Or the third could be in economics. So, let us say economic indicators like inflation or GDP growth rates might exhibit persistence, where economic shocks have a long lasting effects on growth trends, right. So, again the common thread in all the three examples is that if you have some really sharp activity, then it will take a while to sort of come back to the actual levels. So, that activity would have some persistence in the future also. Okay. Now, importance of persistence. So, why should we study the idea of persistence, and then why is studying persistence sort of important, right. So, this is a twofold kind of a idea. So, the first one is forecasting. So, in time series forecasting, identifying whether a process is persistent helps to determine the model to use, right, isn't it. So, if you know that there is some persistence in the underlying data, let us say stock price behavior or temperature data, rainfall data, whatever, then accordingly we can pick the correct model, right. I will give you a very simple example in this regard. So, let us say if you want to forecast, let us say above average rainfall for some reason. So, you have data observations where each observation gives you the amount of rainfall, but then you know for some reason that all these observations are above average. Okay. Then which model should you apply? So, should you apply the ARMA technique or the ARIMA technique or ARFIMA technique, right. So, this is the question. So, correct model to apply would be ARFIMA, because there will surely be some persistence in the underlying rainfall data, alright. Hence, persistence series require models which account for long memory like ARFIMA, right, as they cannot be effectively modeled by short memory models like something like ARMA. Okay. So, in this situation you will rather go with an ARFIMA model as compared to something like ARMA or ARIMA, right. So, the first idea is forecasting. So, why exactly should we study persistence? As to sort of pinpoint to a particular model which could be used to sort of preserve the underlying persistence in the time series, right. And the second angle is risk management. So, let us say often in financial markets, persistent volatility indicates that large fluctuations are likely to persist, right. So, if you have really high volatility, then there would be some persistence effect in the future also, which can be critical for risk assessment and hedging strategies. So, these are some financial terminologies. So, if anyone is sort of familiar with these terms, might have a better connect to this example as to the importance of persistence is also in risk management. So, if you know for a fact that the underlying time series or the underlying data has some persistence, then accordingly you can fit a model and then try to forecast and then try to mitigate the effect of risks. Okay. Alright, so now probably what we will do is we will delve deep into some of the use cases. So, persistence in financial markets. So, the first one is stock market returns, right. So, consider a stock which experiences a sudden surge in the price due to, let us say, positive earnings report. Okay. So, now if the stock's price follows a persistent process, the effects of this information or the effects of this surge will last for a significant period and future prices will remain elevated for a longer time compared to a stock with no persistence, right. So, hopefully I think by now the idea of persistence would be clear, right. So, again if you want to graph this situation, so how would the graph look like? So, let us say it would basically be similar to the graph we drew earlier, right. So, let us say you have a stock price which sort of behaves like that, and then assuming you have a trend also. Now, suddenly some information comes in, right. So, let us say positive earnings report or some really positive sort of an information. So, then what would happen? So, there will be a jump, right. So, let us say the stock price moved there. Now, once the stock price moves there, now again the very next day one can't assume that the stock would again come back to this level, isn't it? Right. So, once the positive earnings report is out, then there is a huge jump in the stock price, and then such a thing may not happen immediately. So, what might happen is that after this huge jump there would be some persistence. So, the stock price might revolve around this range and eventually it would decide its future course. Okay. So, this is the idea of persistence. So, once you see some shocks or once you observe some really high fluctuations in the data set, then it will take some sort of a while to sort of come out of that influence and then come back to the actual levels. Okay. So, the first example is stock market returns, right, and now we will talk about implications. So, what are the implications of the previous example? So, if returns are persistence, okay, if returns of a stock price are persistence, a positive or negative return is likely to be followed by another positive or negative return for a while, right, and this is exactly what we saw, right. So, let us say if you want to draw the graph of returns and let us say this is the 0 line, and then how do the returns behave? So, returns could be either positive or negative, right. Let us say due to the fact that the positive earnings report has come out in the market, there would be a prolonged period of positive returns and there could be some persistence in the series. So, all the following returns may be positive until a while, right. So, this is the idea or this is the implication of the persistence nature, right. So, this can suggest a momentum effect where trends continue for some time, right. Conversely, in a market that does not show persistence, so let us say if you have some data set or some market situation where persistence is not there, for example short memory, right, then price movements may quickly reverse as seen in any mean reverting process, right. So, can you sort of plot this tendency now? Of course. So, let us say if there is no persistence, what would happen? Now, again if you want to chart the returns data, let us say this is the behavior of the returns, right. Now, let us say due to some positive earnings report the returns are positive for some while, but again it will not take long for the returns to be again let us say come back to 0 and maybe oscillate around 0, right. So, the first example is where persistence is there, because here you can see that you have a group where positive returns are together showing persistence, but here even if the positive earnings report was there, when the price fluctuated or the returns became positive or highly positive and then sort of continued for a very short while, but again it sort of reverted back to the mean, right. So, such processes are called as non-persistent processes or mean reverting processes, because let us say mean is 0 assuming, then again initially the mean was 0, but suddenly the mean shifted, but it did not take long for the series to again come back to its mean which is 0, alright. Now, persistence in financial markets, another example is volatility clustering. So, in finance you have this term called as volatility clustering. So, what do you mean by that? So, it means that a sudden increase in market volatility such as let us say during a financial crisis tends to be followed by a prolonged period of high volatility, right. So, let us say if you have really high volatility, then there will be some period in the future also where one can actually observe some high volatility also. So, this sort of tendency is called as volatility clustering, right. So, again if you want to draw the graph of that, again a similar kind of a picture. So, let us say initially the volatility is like that. Now, again let us say the volatility shifts for some reason, and then again in this period you kind of observe the same volatility. So, you have two clusters, right. So, one cluster is here and then the other volatile cluster is right here. So, such tendencies are called as volatility clusterings, or in other words large price movements, so let us say increases or decreases are followed by more large movements while small movements tend to follow small ones. Okay. So, all these ideas kind of point to just one argument or one idea which is called as persistence basically. Now, again the implication of the prior example is what? So, let us say volatility persistence is crucial for risk management. So, if you know that there is some persistence in the underlying volatility, then can you sort of curb some of the risk measures there? The answer is yes. So, a market with persistence volatility implies that periods of high risk, or high risk means what? So, high risk means the market is really volatile. So, large price swings are not isolated events, but are likely to last for quite some time in the future. And then this might require some adjustments in risk models, right. So, if somebody knows that you have some persistence in the underlying volatility and you have really volatile kind of groups in the future also, and there is some persistence in the volatility nature in the future also, then I can accordingly act as per how should my risk management be, right, and then I can accordingly adjust that. And volatility clustering has also an impact on option pricing, right. So, this behavior introduces several complexities in accurately pricing options, right. So, again the idea is that can you sort of capture or can you propose a accurate kind of a model such as ARFEMA or some extension of ARFEMA to sort of capture the volatility persistence. Okay. Now, one more example could be seen in interest rates, right. So, let us say interest rates often exhibit persistence, particularly in long term yields. What do you mean by that? So, small example again. So, let us say if the central bank raises the interest rates, right, if the central bank raises the interest rates, the effects of this policy change may persist for a long time, influencing borrowing costs, savings and investment decisions over extended periods, right. So, again a similar kind of an example as to the prior two that we saw, right. So, what is going on here? So, let us say if the central bank raises the interest rates, so its effect will not die down immediately, this is the point. So, the effect of raised interest rates would lie for some time in the future also, which is exactly called as persistence. Okay. And what could be its implications? So, let us say persistent interest rates might suggest that current levels will remain influential for future rates also, isn't it? So, if you have, let us say if the central bank raises the interest rates at some point, then that particular level to wherever the raise has been would remain influential for future rates also. So, all the decision making, all the risk management, right, would kind of depend on that particular heightened level from now on. Okay. And then this is critical for bond pricing, and let us say bonds are very sensitive to changes in interest rates. So, if you know that there will be some news of increasing the interest rates suddenly, then accordingly I can adjust my risk management, accordingly I can put forward some models to let us say price bonds, etc. Okay. So, long memory behavior in interest rates, especially long term rates like let us say the 10-year Government of India bond, right. So, all these are long term rates, right. I mean once the government decides on the interest rate for let us say 10-year Government of India bond, then it's very rare that there will be some changes in the interest rates, right. So, long memory behavior in interest rates can complicate forecasting and require more sophisticated models which account for persistence, right. So, if somebody knows that there will be some persistence in any of the practical aspects of whatever underlying data you are studying in the future also, then this can actually complicate the forecasting, and one would want a very accurate sort of a model to model the persistence. Okay. Now, how about persistence in environmental data? So, if you shift from let us say financial framework to let us say a different area which is environmental data. So, one very easy example here would be temperature persistence. So, temperature persistence is called a global warming, right. So, the other name for temperature persistence is nothing but global warming, of which all of us are sort of aware now, right. What do you mean by that? That the global average temperature has shown persistent increases over the past century due to let us say climate change, right. So, this persistence is caused by the continuous accumulation of greenhouse gases like let us say CO2, carbon dioxide in the atmosphere, leading to a warming effect, right. And this is exactly what we mean by persistence. So, once you see a very significant increase in the temperatures, let us say a particular year, then that effect will not die down very quickly. This is the whole point. So, if you see a heightened sort of a temperature in one particular day or any particular month, then its effect would sort of go deep into the future also due to persistence, right. What could be its implication? So, let us say temperature anomalies from year to year exhibit persistence, okay, where higher than average temperatures in one year are often followed by higher temperatures in subsequent years, right. And you have some underlying effects also, right. So, you have some temperature effects where if you have higher temperatures in a particular year which are sort of above average, let us say, then the very next year you also sort of observe the similar tendency. So, again like I said, it will not happen that in one particular year you are seeing higher than average temperatures, and then suddenly in the next year, let us say starting from Jan onwards, you are seeing below average temperature. So, such tendencies are not possible, right. And this is an important implication of persistence in, let us say, temperature data, okay. So, persistent temperature rises can affect ecosystems, weather patterns and human health over longer periods, okay. So, persistence, be it in finance or let us say environmental data, requires some attention. So, this is the whole point. So, we can't simply try to model that using, let us say, some ARMA processes or ARIMA processes, SARIMA processes. So, we require to capture the underlying persistence as well, alright. So, persistence in environmental data, one more example could be, let us say, precipitation and drought persistence. So, droughts often exhibit persistence where below average precipitation or below average rainfall continues for extended periods, right. And this can be due to some interaction between atmospheric circulation patterns and land surface conditions, whatever, right. Now, again the whole idea in both the environmental aspects or environmental examples is that if you are seeing some heightened temperatures and let us say drought like situations, then such situations might take a while to sort of come back to its actual state or come back to its standard state, alright. Now, what would be drought implications? So, regions like California or Australia frequently experience drought persistence. So, where you see dry years followed by more dry years, leading to water shortages and environmental degradation. So, long lasting droughts can severely impact agriculture, water resources and ecosystems with long recovery periods required once the drought ends, right. Now, the last slide for today would be what do you call as anti-persistent time series. So, anti-persistent time series is any time series where you do not observe any persistence, right, or the other name for this is mean reverting. So, we have seen one example before also. So, anti-persistent or mean reverting time series means that an increase in the time series will be followed by a decrease and vice versa. So, let us say in one year you are seeing increased temperatures, the immediate next year you will see decreased temperatures. So, this is what is anti-persistent behavior, right. So, sequences in which high values are often followed by low values and vice versa. So, sequences where low values are followed by high values demonstrating a tendency to revert or oscillate between the extremes, right. So, once the series reaches one of the extremes, it would have a tendency of again reverting back and then attaining the other extreme. So, maximum to minimum or minimum to maximum, etc. So, such behavior is characterized by a negative autocorrelation structure, meaning that periods of high or low values tend to be followed by periods of low or high values respectively. So, of course, there will be some negative sort of a autocorrelation. So, again the last thing we will do for today is I will try to graph this tendency. So, let us say again if you want to draw the ACF plot for some reason, right. So, this is the ACF plot of an anti-persistent time series, and again let us say these are the bands. So, in the first state if you observe positive correlation, then in the next state the correlation might be let us say something like negative. So, something like that, then again positive correlation, right, and again negative correlation. So, here you might want to extend the axis to a negative side also. So, this is the positive side and this is the negative side. So, here can you see a negative correlation. So, once you have high temperatures, then the subsequent year or the subsequent time point you will see low temperatures, right. So, the correlation between the high observation and the low would be kind of oscillating, okay. So, again in the next session we will talk more deeply about the ARFEMA process. So, how exactly can you sort of make use of the ARFEMA process to capture the persistence in any underlying time series, okay. Thank you.